The economy and stock market are two different things, but they have an undeniable relationship with one another. Generally speaking, over time, if the economy is running strong, then the stock market will rise, and vice versa. So, as investors, we want to see that the economy is growing and that all economic indicators are positive. If, however, the economy takes a turn for the worse, the markets will quickly price this in as they were always forward-looking. One source of economic data to consider is the monthly jobs report. A strong jobs report doesn't guarantee a strong economic future, but it's definitely an important puzzle piece. There's been a lot of uncertainty with the economy and a lot of mixed signals recently giving investors some fear, so hopefully going over these numbers will give you a little bit of peace of mind. The seasonally adjusted jobs added came in at 467,000 for the month of January, and as you can see from the graph, the unemployment rate changed little from the previous month. We can also see that after the initial spike in early 2020, the unemployment rate has been trending down toward its pre-2020 level. Another key takeaway from this report is the labor force participation rate. The unemployment rate does not tell us the full story. It only measures those who are currently unemployed but are actively looking for work. So, if someone were to give up looking for work, they would not be considered in the calculation of the unemployment rate. If we take a look at the numbers, we see the labor force participation rate came in at 62.2% for the month of January. But prior to February of 2020, the labor force participation rate was higher. It came in at 63.4%. Similarly, the employment population ratio measures the ratio of people who are of working age compared to the number of people actually working. We are currently at 59.7%, but again, before February of 2020, we see that this number was higher at 61.2%. Both of these statistics show us that there are now many people who've simply quit looking for work altogether, which does not show up in that unemployment rate. So even though we're down to 4% unemployment, there's a bit more distance between where we are now and pre-February 2020 numbers than first meets the eye when we're only looking at the unemployment rate. If you were to continue looking at all the stats from this report, you'd find some numbers that are good, some that aren't too impressive, but considering we just got off a big spike in cases, it would have been possible to see a significant worsening in the data. There's a bunch more to this report if you guys want to read all 43 pages, but today in this video, I just wanted to give you a meaningful sample of what's going on. Overall, I'd give it a B. It wasn't a total home run, but given some of the challenges that we've been facing recently, it was definitely solid. I've seen some media outlets call it fantastic, but I think this is a bit of a stretch. Meanwhile, we continue to see elevated levels of inflation. When the January numbers came out, it showed 7.5% inflation annualized. Ouch, it continues to creep higher month in and month out. Also, there's fears that Russia is going to be invading Ukraine. There's so much going on right now, it's hard to keep track of it all. But the best thing we can do as investors is to remain invested. With that said, guys, if you've made it this far in the video, thank you so much for watching. Don't forget to like the video, comment down below, and consider subscribing. Until that next one, peace.